Good morning. So today we are going to see reporting in business management. Okay. So let us see what is meant by reporting. So reporting is nothing but it is in business management. It refers to the process of collecting, analyzing, and presenting the business data and the information which is related to the business, and it will be in the structured format for decision making. Okay, and it allows the manager and stakeholders to monitor the progress, performance, and financial health of the organizations. So this is the main tool for everything to know about the company. Okay. So next definition of the reporting. So reporting in business management is defined as the systematic process of preparing, summarizing, and delivering the data on various business activities to management or external stakeholders for effective decision making, evaluation, and control. So what are the different types of reporting in business management? So first one is based on the purpose, and second one is based on the frequency, third one is based on the nature, and fourth one is based on the content. So let us see one by one in the elaborated manner. So first let us start with the based on the purpose. So based on the purpose means if there is a purpose need exist means this type of report will be prepared. Okay, so first one is informational report. So this this provides the information on specific aspects of business without analysis or recommendations. For example, monthly sales report. Okay. Scan one is analytical report. This contains data along with the analysis and recommendations for the improvement purpose. For example, market analysis report. Okay. Third one is statutory report. These are legally required reports submitted to the government authorities. For example, annual financial statements. Next one is voluntary report. These are not legally required but prepared to provide the insights to the management or stakeholders. For example, sustainable report. Next heading is based on the frequency. So based on the frequency means in the periodical frequency they will be preparing this report. First one is periodic report. These reports are prepared and submitted at a regular interval to the management. For example, it may be prepared in the daily manner or in the weekly or monthly, quarterly or annually. Okay. For example, quarterly financial reports will be submitted to the management. Next one is ad hoc report. These are created for the specific purpose or events, usually as whenever it is needed base exist. For example, special project report. Next one is based on the nature. So internal report and external reports comes under this category. Internal report. These are meant for internal use within the organization, focusing on operational performance, employee productivity, or financial status. For example, department performance reports. Next one is external report. These are prepared for external stakeholders such as shareholders or for the regulatory authorities or for the publics. For example, financial reports. Next one is based on the content. So based on the content is prepared, the report is prepared on the content which is available in the report. Okay. For example, first one is financial reports. This provides the information about the financial performance and positions of the company. For example, balance sheet, income statement, or cash flow statement. Next one is operational report. Focus on the day-to-day operations and efficiency of the business process. Example, production report, inventory report. Next one is sales and marketing report. Contains data on sales performance, customer feedback, and market trends. For example, sales revenue reports, customer satisfaction surveys. Next one is human resource reports. This helps the management to track the employee performance, recruitment, and the workforce management. For example, employee turnover reports. Next one is reporting procedures. So what is meant by reporting procedure? The reporting procedure in business management refers to the systematic process of collecting, organizing, analyzing, and presenting the information, and which helps the manager and the stakeholders make informed decisions. Okay. This will ensure that relevant data is accurately captured and presented in a structured format aiding in performance evaluation, strategy development, and business operation control. So what are the steps in reporting procedures? First one is we have to collect the data. So first one is data collection. The first is gathering the relevant data for the various sources within the organizations. So that is the data collection. Second one is data organization. So once data is collected, it is needed to be sorted and organized based on the type of report required. Okay, so that is the data organization. Next one is data analysis. So analysis the data is crucial for identifying the trends, making comparison and interpreting the information. So next one is preparation of the report. So after the analysis is done, the report is prepared, summarizing the key findings and relevant data is in a structured format. And review and reapproval. So this is the next step. So before finalizing the report, it undergoes a review process to ensure the accuracy, relevance and objectivity. Next one is presentation and distribution. So once it is approved, the report is presented to its Indian audience, so which may be included management, employees, stakeholders or regulatory bodies. Last and thing is feedback and follow-up. After a report is shared, feedback is often gathered to assess its usefulness and accuracy. Next one is ideal control system. So what is ideal control system? Let us start with what is control system. Control system in business management refers to the set of process, policies and mechanism that manager use to monitor organizational performance, compare it with the established standards, and they will take a corrective actions whenever wherever it is necessary. So let us see what is ideal control system. So ideal control system is the one that operates effectively and efficiently, allowing the manager to maintain overall control aspects of the organization where there is enough to adapt to change in the organization. Next one is what is the meaning? So feedback control system in business management refers to a system where actions are taken after a process or activity is completed based on comparing the actual outcome with the desired objectives or standards. The purpose is to evaluate the performance, identify the deviation, and implement the corrective measures to improve future outcomes. So feedback control focuses on learning from past results to guide for the future actions. Next one is definition of the feedback control. So it is a type of control system where the actual performance is compared with the standard or desired performance after the task is completed. So if there is any discrepancies between the two are identified and corrective actions are taken to align the future performance with set standards. So these are the steps in the feedback control. So first one is we have to set the standard. So first and foremost thing is that we have to set the standard for the organization. Next one is we have to measure the actual performance. So after setting the standard, we have to measure the actual performance the of the business or performance process. This is involved. Next one is we have to compare the performance with the standard. So the actual performance is then compared with this state standard to identify any deviation or discrepancy. So next one is analyzing the deviation. So while deviation occurs, the process of discrepancy is analyzed. Next one is taking corrective action. So based on the analysis, corrective actions are taken to improve the future performance. Okay. Next one is types of feedback control. So in the types of feedback control, there are two types of feedback controls are there: negative feedback control and positive feedback control. Negative feedback control is this type is means the control occurs when actual performance is below standard and promoting the corrective actions to improve the performance and reduce the deviations. Okay. For example, if the company sales figures are lower than the expected, so marketing effort may be increased to boost up the future sales. Next one is positive feedback control. So positive feedback control happens when the performance exceeds the expectations and the standards, which leads to the reinforcement of the successful strategy or